Phil, as we promised the audience, 4 new trades to go over. Why don't we start with Bank OZK? That'd be Bank of the Ozarks, isn't it?
Bank of the Ozarks, that's right. Although it's mostly basically, you want to think of it as a West Coast bank. And they're a baby with the bathwater kind of stock, which means they got thrown out with a lot, they got thrown out with a bunch of bad banks, but they're not a bad bank at all. Everybody's terrified of the regionals. But the Fed is eventually lowering rates. That's going to be good for them. Homes can't get worse than they are now. So we love them down here. They're less than 10 times earnings. And we also love something when we can make a great options play out of it, and here we can. And the trade idea that we're working on there is to sell the 2027 $45 puts, and we can sell those for $7.50. So if you do that, that means your net entry is going to be 45 minus 750, which is it's 3750. There you go. So you would net into the stock to 3750. And then as a spread, we take that $7,500 we collect, and we set up a spread of buying 20 of the 40-52 spreads, and that's going to net us in for $5.60. And the whole spread then in that case becomes a $3,700 cash outlay, but we can make $21,300 on the spread if it hits 52.50 in 2027, and that would be a 575% return on our cash. So it takes us from liking it to loving it, especially when we don't need to move very much in order to hit our goal.
What's the risk here? I mean, you just talked about what the upside is here. What's the risk if the trade doesn't go your way?
Oh, well, if the trade doesn't go our way, you're forced to buy the 4,500, the 1,000 shares. You're forced to buy 1,000 shares for $45, and we already put 37 into the trade. So, assuming it goes so badly that we can't cash out anything back from the trade that we put in, and assuming that we're forced to buy it at 45 because we didn't stop out, then we could lose $45,000. But that's honestly, that you would have to suddenly go bankrupt in a way that you can't fix it. I mean, you can stop out of these trades. You're not going to take a full loss. But if you want to talk about risk, that's your maximum risk.
Okay, it's good to know that. Next one on the list is the 4 is Foot Locker. Walk me through this trade.
The thing about Foot Locker is when you listen to Nike's earnings, Nike used to be about 60% of Foot Locker's sales. In 5 years ago, 2020, in 2020, the CEO that came in decided they weren't going to be in retail anymore, and they would only their own stores, and they pulled out of Foot Locker, which was devastating for Foot Locker too. And there's a lot of bad blood there. And now Nike, it went so badly for Nike that they're now pushing back into the retail channels. But to do that, they're going to have to give concessions to Foot Locker that are going to be very beneficial for Foot Locker, and the traffic will come into Foot Locker because kids want the Nike still. So we love it as a trade. And here we're selling the 1750 puts. We're going to sell 20 of those for $9,200. We take that $9,200 and we apply it to the spread, which is going to be 40, twice as many as we're selling puts. We're going to buy 40 of the 1250, 2250 spread. So that's a $10 spread, and that's going to be $40,000 total potential dollars on the spread. We're laying out $5,600 total. That's the spread minus the puts, and that's a $5,600 cash outlay. So we have a $34,400 upside at $22.50, and that would be a 614% gain if we hit our goal on that one. And by the way, that trade is starting out. I want to make sure you understand this. It's $5,600 net dollars, and we're starting out $14,400 in the money. That's why options are so great.
Foot Locker. Next one on the list is Whirlpool Corporation. This one crops up in the tariff headlines, doesn't it?
It does, and interestingly enough, we had Whirlpool. We dumped out of it because we were worried about the tariffs. It was in our long-term portfolio, and we loved it. It was a great stock, but we got worried about what would happen with tariffs. Now, since then, Whirlpool's come down considerably. I was not going to buy it, but Bodie, who's one of my AIs, when we were talking about the stocks that we had dropped, he said, "What about Whirlpool?" And I said, I don't like it because of the tariffs. And he goes, 60% of their stuff is made in the USA, and it's not washers and dryers like you think of. They make a ton of convection ovens and toaster ovens and blenders and things like that, and that's 60% of their business. And all of a sudden, I was like, "Oh, really?" Combine that with the huge drop they had, and now they became very interesting to me again. And again, though, the closing for me is when I look at the options chains and I say, "Holy crap, we can make a great spread off of this one." So in this case, we're selling just 5 because it's a $100 stock. We're just selling 5 2027 $100 puts. We get $21.50 for that. So that means we're netting in for $78.50. And I think it's at 95 now, Whirlpool. So we're netting in 20% below the current price. We're going to be very aggressive with this one. We're buying 15 long 90 calls for $26,000. We're selling 10 instead of 15. We're not fully covering. We're selling 10 of the 110 calls. So we have a $20 spread times 15 means 30,000 potential dollars in the back end. And I think there's another slide. We're using that gap, the 5 unsold long call, the 5 unsold short calls to cover, and instead we're going to sell the June 97.50 calls, which is just above the current strike. We're going to collect $2,700 for those, and we're also going to collect $5,000 selling the June 100 puts because we really, really believe the 100 is much too low for this stock. In doing so, we're collecting $7,700 for 88 days. And the whole trade is a $1,200 credit. It's got a $30,000 upside, so we actually have a $31,200 credit, potential upside on the spread.
All right, that was an involved one. Yeah, I'll let you finish your thought there.
I'm going to come back and I'm going to teach you guys how to manage this spread. That's the point of this. I'm going to teach you how to create an income stream off the spread.
Okay, we got 1 minute now for ArcBest. Give me the elevator pitch here on this trade.
Okay, now ArcBest is also taking advantage of the trade situation. They're a logistics company, and they are going to have a lot of companies are going to have to change the way they're doing their logistics, where they're getting their supplies from, moving their supply chain around. So they're going to do fantastic consulting and working with companies that have to do different things in order to get around the tariffs in the United States. They've been a great growing company. They're very sleepy. They're trading at about 10 times earnings, and we love them. And again, the selling pitch here is when you look at the options chains, we can sell 5 $75 puts for $11. That's $5,500. We can buy 10 of the January 70-90 spread. So $20 spread times 10 is $20,000. And that nets us in for $1,000 on a $20,000 spread. And that means we have a 1,900% upside potential against 1,000.